Hello everyone. So this is going to be a video on going over the Footwear Industry Report. So you can see this is mine for the Best Strategy Invitational that I've been playing, and year 11 scoreboard. So you can see I am currently in 4th place with an investor score of 110, best in industry score of 76, and then a weighted average of 93. So I didn't do as well as I was hoping for, but that's okay. I still have a lot of more decision rounds, and you can always make a comeback in the future, and that's what I'm going for, is a long-term strategy. But this video is going to go over exactly kind of the things that you're going to look for when you're going through the Footwear Industry Report, and yeah, we'll get started. So game to date score, this is where you're going to notice your current scores, weighted average score, and then bonus points if you get any bonus points, which I'll show in one of these other pages. Here's the explanation of what the investor's expectation score means, best industry, and then the weighted average. So for the earnings per share, you can see here your earnings per share, number one, the first place will be highlighted yellow for that year, and then the next ones are going to be in black. So you can see I did fairly average, not spectacular, but okay. And over here, so as long as you are above the average or the investor expectations over here, it's by 40%. So if you're over that investor expectation by 40%, that's where you're going to get 24 points here. Best in industry, to get the max points, you have to be number one in the industry. So they got 20, and then it's based on a percentage from the best in industry. So I was about probably 75% from company D. That's why I got 15. And then you get a game to date score, which usually is your weighted average, which is the past 3 years. And that's towards the end, that's where you're going to want to focus on, is the past 3 years weighted average. And that's going to be your end game score. Return on equity, here you're going to see your return on equity percentage against the competition. Same thing. As long as you are above 40% of the investor expectation, you'll be at 24 points. Best in industry against your competition, you'll be at 20, and then down from there. Stock price, same thing here. And this is, you're going to notice this pretty similar to all of them, but one thing you're going to want to pay attention to is this is going to increase every single year. So you have to make sure you're steadily keeping your stock price growing, especially these last 3 years that you're playing. Mine were before in year 13 to 15, but this one is a 10-year round or 10-year simulation. So I'm going to be focusing on 18, 19, and 20 for make sure I have good scores. Credit image rating, same thing. You can see I was at an A-, and investors were expecting a B+, so I did fairly well there. Best in industry, since we all tied pretty much, we all got 22 or 18 here, and then investor expectations were 22. Image rating, the same thing. As long as you're over 40% of this, you'll get 24 points approximately here. It gets pretty difficult once you get up to these higher numbers to get above 40%. The max is, I believe, 100. So you can't necessarily always get 24 points. Then we have corporate social responsibility. This is where you're going to notice if you are investing a low amount, average, or high. Usually, from what I've experienced, is you want to stay around that average mark. You don't necessarily need to be the highest to gain the best benefits from corporate social responsibility, but you definitely want to make sure that you're probably not the lowest or the highest. So stick around that average. You should have a pretty good image rating points generated from expenditures. So here's the bonus points awards, and this is a little confusing at first, but pretty much what happens is those forecasts that you make in wholesale marketing and internet marketing, and the forecasts on private label. So this has everything to do with your projections. If your projections are within a certain percent variance, plus or minus of 5%, you're good there, and you have to hit 3 of these to get the award. So, for example, I was at negative 9.2 in my projections, so I did not qualify for the bonus point. Let's say D, they were in here, but they missed this one by a lot, so they were not qualified. So you have to hit you have to hit all 3 of these qualifications to be able to get a bullseye award. So it's really important when you're working on these, you make sure that they're as accurate as you possibly can. I know when I first started playing the game during my master's of business administration, we were trying to be as conservative as possible with these numbers, and it kind of impacted us because we couldn't win a bonus point because we weren't trying to project exactly what we were going to get. We were trying to be conservative so we could make our numbers look okay. And then the leapfrog award, this is a beneficial award because you get a point as long as you gain the most net change in your score over last year. So this is really beneficial, and this is where you can become an underdog, is to get these extra points. So for example, these companies down here, which seem to be grouped doing the poorest, they have a really good chance of leapfrogging in year 11. It only begins year 12, 12 to get that extra point. So this one is also a good one. So that's what you don't have to worry about if you are doing bad. Just be aware that you can gain some extra points here by making great strides in your company, which is definitely possible. If you're doing bad, don't worry. Industry overview. So this has some good information. It's going to explain what happened with the prices of materials. So you can see here, material prices skyrocketed for standard materials. We had a $7.30, which is crazy. It's very high. A lot of people were using standard materials in their shoes in this past year. And footwear production and sales, this is where you're going to see the demand forecasts versus the actual pairs sold. And you can also see the private label demand forecast and if there was how many pairs offered versus pairs sold. This is fairly useful, but not necessary. It just kind of gives you a good idea of what the demand is going up in. Here's another demand forecast. So this is for branded and private label. This is pretty standard information. It's just showing you what you should expect for demand to go up. Here's something that you should pay attention to, and it's very helpful. So as you can see, this analysis right here is really important to read and understand. So potential global supply. So our potential global supply is way above expected global demand, which means that in the last year, you can see down here that everybody bought a bunch of new production space. Well, this added production space is going to be wasted cost if they don't use it. So you have to expect that competition is going to be very strong in the next upcoming years because these companies are probably going to want to use the space that they just built, and it's going to make it very competitive that they're going to want to try and make the best shoes. They're going to want to stimulate their sales growth to accommodate their extra space. So you want to make sure that you're not lagging behind in space, but it's really important not to overexpand. So you can see I expanded 2,000 in Latin America, which is important to get rid of tariff costs. But you can see these companies expanded 8,000 combined here, 10,000 combined here. It's just ridiculous amounts. And I think they're going to have a lot of trouble hitting the sale demand to overcome this extra debt that they added to their company. So I wouldn't be surprised if these companies have some problems in the future. And then you can see over here who's adding production equipment. So next year, I'll probably notice a lot of people putting production equipment in Latin America and some in Europe as well. But it looks like a lot of people maxed out their production equipment in North America and Asia Pacific, which is because it's always best to max out the space that you already have, which is exactly why I think these companies that put so much in here are going to have problems with debt in the future. Financial statistics, this is good information to look at. It kind of shows your internet sales, wholesales, private label, totals, and it goes all the way down to net profit. More important is kind of looking at the balance sheet. So I can see that long-term loans, you already noticed that these companies right here that expanded a lot have a lot of loans, a lot of long-term loans that they're going to have to pay off. And it's going to be potentially devastating for them in the future. I got up to about 184,000, which is even, I noticed for myself, even at that, I've already am going to have trouble with my default ratios. The best thing about the financial page right here is looking at your profit margins, your net profit margins. You always want to make sure these are high. You can see I was probably a little bit above average, but this is a great benchmark to see where you're doing in net profit margins, which you always want to be high, and looking at the gross profit margin and operating profit margin to see kind of where your sales are and then how you're operating the company as well. And then dividends. This is something which is important to kind of see who's paying dividends. I've noticed that it's best to not pay dividends until you're successful and you are towards the end of the game and you need to pay dividends to make sure your earnings per share is high. Here are some other interesting ratios. Make sure your interest coverage ratio is always high. Debt to asset ratio you want to keep low. If you eventually want an A+ credit score or credit rating on the game, you need this to be around 0.1. And then your default risk ratio, you want this to be low as well, high. You want it to be high. And current ratio, this is saying how much inventory you had left over and days of inventory. So I had a lot of days of inventory. I had too much inventory on hand and it hurt me in the end. So make sure that your days of inventory are as low as possible, but don't lose sales because of it. And then shares outstanding. Make sure that you keep paying off or keep buying shares back as much as possible because it's going to help your ROE and EPS scores. Production benchmarks. This is where you're going to be able to see a lot of information on how you are averaging against the industry. So usually you want to stay above the industry averages. So you can see here I am above the average for total regular compensation, which is great. I'm a little bit below average in workforce productivity, but that's probably because I spent so much in total quality management in Sigma 6. And you can see production labor costs. Mine was at a 9.23, which is because I spent so much money in best practices, which is a cumulative long-term strategy that I'm taking. You can see supervisory compensation as well. Reject rate, I had the lowest reject rate, which is saving me a lot of money. But to get this, I had to spend a lot of money in total quality management and best practices training. You can also see your total production rate cost, which mine was high, which I was expecting. And eventually that's going to get lower because I'm taking a long-term strategy. And the same thing with Asia Pacific. And then you'll notice as people start building shoes in Europe, Africa, and Latin America, you'll notice that as well. I'll show you statistics. Cost per star, this is a great thing to keep as low as possible. It means you're doing really well in your production compared to your star rating. Operating benchmarks. This is a good way to see how your warehouses and everything are doing compared to the competition. So you can see I have extremely low, the lowest warehouse costs in North America at least, and Europe, Africa, Asia Pacific, and Latin America. So my warehouse is doing extremely well. I do very well with warehouse distribution. You can see cost for branded pairs sold, your marketing expenses. Mine was at a low because I got rid of all my marketing for especially internet sales because it didn't seem to provide a return on investment that I was looking for, and profit margins, etc. So you can look through all of this. And then private label operation benchmarks. This is where you're going to see what people are charging and approximately how much they're making per shoe sold in private label. So you can see the lowest was $24.98. This does not necessarily mean that they lost money. They could have still had this low price and still have made money. depending on how well they did with their compensation, uh, everything that goes into making the shoe for private label. So do not conclude that just because they were lowest, they were losing money. As you can see here, I actually lost a little bit of money on mine. And so I was the lowest, but I also charged the most because I had bad private label operations. Celebrities and trends. So this is where you're going to see what people are paying for celebrities. You can see that unfortunately I did not get any celebrities, which I'm hoping I can get this year. There's a lot more that are coming up for me this year that are unassigned at this time. You can only have a max of 3 celebrities, and it shows you the highest offer, second highest, and third highest offer. Of course, you want to be the lowest offer. Like, so for example, Company G, they got extremely lucky getting this for such a low price. Then pricing and SQ trends. This is a great way to kind of see where the competition and the averages are going. Now, in another video, I noticed when I was doing research, this usually goes up towards the middle and then it starts to go back down towards the end. So make sure you take that into consideration when you're playing the game to understand that this is going to go up, then back down. Same with internet price. You'll probably notice it go up and then back down. Now, it depends on a lot of different metrics, and as you play your game, you'll notice that just because of what you're seeing in mine does not mean it's going to correlate to exactly what's going to happen in yours, because there's so many different variables in the game that make everything change. So you can see here that SQ rating went up. I expect this to continue to go up, as well as prices. So when I'm going back into here, I'm anticipating this to go up to better understand my my competition, and hopefully get a better projected so I can win that bonus award point back here. So this is the video just to kind of go over the footwear industry report, which is really important to look at before you make your next decisions. And then in another video, I'm going to work on the competitive intelligence, going over that. And then today I also have my decision entries for year 12. Then I'm going to explain what I'm doing and why I'm doing that as well. So thank you for watching.